let's do the last three because I'll race.
Yeah,
through
you want to
them.
go for them? Okay, so on the subject of e-commerce for the moment, then, Steve, tell us about Etsy.
Etsy, I would describe as a very reliable kind of tech stock. Revenues came in 5% above consensus. The beat marketplace and services revenue. Adjusted EBITDA came nearly 17% over consensus. EBITDA margin came 281 basis points over consensus, and they guided just a little bit below, and they guided for a stronger EBITDA margin. So Etsy did really well the day after their earnings. It was up about 8%. For me, that just looked like the company that's continuing to perform.
Yeah, that's a really interesting stock. I kind of like Etsy, and I sort of want to see it run a little bit more. I'm torn on this one, right? I want to see it go a little bit longer and prove itself to be durable in a kind of downturny economic thing and see what happens there. But I also am conscious that if I wait for it to do that, it may well be out of sight by the time I get a chance to do that.
So another one that reported in that sort of in this window was Spotify. It's been quite sort of largely overlooked. I think it was on Tuesday lunchtime. It reported revenue up 23% to 2.9 billion euros. Gross profit up 6% to 704 euros. The margin was down just a little bit year over year. EBIT minus 194 million euros. Free cash flow though, 37 million, up 9% year over year. That's about a 1% margin. A couple of stats I pulled out of the earnings call. They think they're going to have 1 billion users by 2030. They didn't actually give you the mix of premium and not, but they think they'll be able to attract 1 billion users. And that's actually the 9th straight quarter in a row that Spotify have generated free cash flow, which is pretty impressive for a company of that kind of size. Obviously, they're discounting the stock-based compensation here, but free cash flow is free cash flow, I guess.
Yeah, it is. And it's a thing that people are all kind of very keen on talking about at the moment, with sort of interest rates going up and it being harder to borrow. A real emphasis on positive free cash flow if you want to kind of be down the growthier end of things, which I guess Spotify counts as. It's probably still a Cathie Wood stock. I never really know exactly what Cathie Wood owns at any given moment, even though that stuff is publicly available. But encouraged by Spotify then? Pretty much,
yeah. I think they're getting to the kind of numbers now of premium subscribers, which where Netflix started to be tripped up. But the beauty of Spotify, I guess, is that they offer the longer free trial, plus they offer the crap ad-supported version, which everybody hates, and a real reluctance to increase the prices. So it would be interesting to see just how Spotify's premium subscribers, if they can drive through that kind of like where Netflix has got caught up a little bit and see where they end up.
Okay, let's go last one then. You were looking at Kering, and I was not surprised by what you found on this, but do tell.
Kering had a very, very good first half. Group revenue was at 9.9 billion euros, which is up 23% year on year, 16% like-for-like currency. Operating profit was 2.8 billion euros, up 26%. Operating margins at 28.4%. All of this while Russia's locked out of the market. China is pretty much locked up in the homes. Kering said that in their report, Gucci, which is their largest brand, was essentially flat, only up 4%. It's pretty big in China. It was pretty big in Russia, so that explains that. Exciting times ahead, I guess, if China curbs COVID quickly. Saint Laurent grew sales 42%, Bottega 18%. I don't actually know how to pronounce that. Is it Bottega?
I would have pronounced it the way you first pronounced it, which means that since I'm as much of a Philistine as you, it's probably different.
Yeah, and there was also Alexander McQueen, Balenciaga, Boucheron and Pomellato. They're the other little fashion houses. They grew at nearly 32%. They've bought back 650,000 shares, about 0.5% of their outstanding. They're going to generate about 4 billion in free cash flow this year, so quick maths. That's about 17 times free cash flow. Fashion conglomerate firing on all cylinders.
I'm not surprised by that one. It's a kind of high-end fashion conglomerate as well, right? So I did see in the week that LVMH done pretty well, and I sort of associate those as aiming at the same kind of target market. So just to kind of finish where we started, I guess, a little bit. Stuff like Kering, stuff like LVMH gives you a feel for how the sort of high-end consumer is doing. And things like Dollar General or that kind of thing, I suppose, give you a feel for how the kind of, I want to say lower end, but people who shop kind of down towards the more price conscious end of things are doing. So keeping an eye on those gives you a feel for how different parts of the economy are kind of moving. LVMH and Kering are both fairly international, right, with their kind of brand power. But I guess that's a reason for being interested in these stocks, even if you don't own them, as I don't own either of these. You own Kering, Steve?
I do. I actually doubled my position on the back of the earnings as well, quite begrudgingly because they shot up a little bit, but I just thought they were a very impressive earnings report. And I don't think, as much as it is difficult to average up, I don't think that price is particularly egregious.
I'm intending to have a look at something in this space. I was impressed by LVMH for what it was worth as well.